Hi, I'm aging, just like you are, just like everybody else. There's an old saying, growing up is optional, growing old is mandatory. And as I age and discover that I have more years behind me than ahead of me, even with the most optimistic of lifespans, I'm reminded of the pluses and minuses of aging. Now you say, what pluses of aging? Well, I have fewer financial constraints and work constraints than I used to, more time on my hands. That's a plus. And the minus is I cannot do things now that I used to do a decade ago, 2 decades ago. You think, what's this got to do with business and investing and valuation? Now, starting about a decade ago, I started thinking about how companies and businesses age just like human beings do, and how just like human beings, they fight aging every step of the way. I'm reminded of this every time I see a mature company trying to do an acquisition to be young again, a facelift, or pay a consultant to be young again. Now, as I look at these companies behaving, I also think about what I do, which is teach. And I teach 3 very different classes. Corporate finance, where I talk about the first financial principles on how to run a business. Valuation, on how to value these businesses. And investing, which is, as an investor, how do you decide what business to invest in? And I'll be honest, in all my classes, I'm in search of the Holy Grail. Something I can use to explain everything that's happening around me. I'm not quite there yet, but the corporate life cycle gets me fairly close to being able to do so. I find myself going back to it's a gift that keeps on giving when I teach in my corporate finance class to explain why businesses do what they do at different stages in the life cycle. In valuation, to talk about the challenges you face as you value young companies versus mature companies. And in investing, in explaining why growth investors and value investors have different mindsets and different skill sets and can still succeed. So in this book, I've tried to take all of those different and divergent thoughts sometimes on corporate life cycles and put them all into the book. As a consequence, it's a mishmash. It's a little bit of management, a little bit of corporate finance, a little bit of valuation, a little bit of investing. And I hope it attracts a very diverse audience as a consequence. Now, just to lead into the book, you're saying, what's a corporate life cycle? It looks very much like a human life cycle. It's like, a startup is like a baby. A very young company is like a toddler. Falls, gets up, sometimes cannot get up. A high growth company is like a teenager. Lots of potential, but sometimes does things to screw up its potential. A mature company is getting approaching middle age or in middle age. So it's going to find its limits as it becomes middle age, and then you're going to decline in death. A couple of caveats. Not all companies move through this life cycle at the same pace. GE lasted 130 years from birth to death. Yahoo managed to do the same thing in 25 years. In this book, we're going to talk about what it is that drives the life cycle, why it is that some companies are able to climb the life cycle quickly. And we're going to talk about the forces that slow down the climbing of the life cycle are also the forces that keep you at the top for longer and make decline more gradual. So we're going to talk about differences in life cycle and why the 21st century company has a much more compressed life cycle than the 20th century company. We're going to talk about how that plays out in different aspects of finance. Now, just as a little lead-in on what we're going to try to do in this book, after we've laid the foundations of what it is that drives the life cycle and how to measure where your company is in the life cycle, we're going to turn our attention to corporate finance. After, again, a chapter that established the first principles of corporate finance. It's not rocket science, and how to run a business and how it plays out in investing, financing, and dividend decisions. We're going to talk about how the focus in corporate finance shifts as companies age. Young companies, it's all about the investing decision. With mature companies, you're going to see a shift towards financing decisions. For declining companies, you'll see an emphasis on dividends and how to get cash back to the owners. It's not that the corporate finance first principles change, but the emphasis changes, and companies that refuse to act their age, a young company that tries to borrow money, a mature company that tries to grow too fast, will run into the limits of what they're trying to do. Once we've got corporate finance under our belt, we'll turn our attention to valuation. Again, after a chapter that lays out the basics of valuation. If you've never done valuation, never fear, that chapter should do it. The drivers of value. We're going to talk about valuing young and startup companies, and then growth companies and mature companies and declining companies. And while the principles don't change, the challenges will. The uncertainties change. And the biggest change you're going to see as you look at valuation across the life cycle is early in the life cycle. We're going to talk about value being a bridge between stories and numbers. Early in the life cycle, it's a story that drives your value. But as companies mature, the numbers will start to drive the value. And we'll see the challenges that come about as that balance shifts as companies age. So that's corporate finance and valuation. Third phase, we look at investing. You've heard the old battle between value investors and growth investors, each claiming to own the high ground. I don't believe either does, because they pick on different companies at different stages in the life cycle. Growth companies, especially young growth company investing, venture capital investing, is all about investing in very young companies. The skill sets you need to find good investments is very different than the skill sets you need when you're looking at middle-aged companies, mature companies. If you take a good value investor and drop them into the VC space, they'll probably crash and burn. Take a good VC investor, drop them into the value investing space, they're not going to be happy either. We're going to talk about how investing shifts as you go from startup VCs all the way into decline, where we'll talk about private equity and companies that investors will essentially try to make money on companies as they shrink and go away. In the last few chapters, we look at managing. I know that this legend of a great CEO and the characteristics that make for a great CEO. I'm going to argue that there's no such thing, because the right CEO for your company will depend on where you are in the life cycle. Early in the life cycle, you need storytellers, not business builders. Later in the life cycle, you need business builders. And for middle-aged companies, mature companies, you need people who can play defense. The skill sets you need in your CEO shift as companies change. Which raises a tantalizing question. What if the CEO of your young growth company, great CEO, is no longer the right CEO for your company as it becomes a mature company? We're going to talk about the corporate governance challenges that emerge as a consequence and the mismatches between companies and management. We'll close off the book by looking at every company's dream, which is reincarnation. You too want to discover that fountain of youth. And there are companies that have done it. They're legendary. Apple in 2000, Microsoft in 2014. We're going to talk about the challenge on reincarnation and why so few companies succeed, and whether you should be mapping out a plan for reincarnation. As you can see, this book covers a lot of very diverse topics. It's not designed for people who just do finance or people who just do management. And I hope you will find all the chapters interesting, but I'm probably being unrealistic. There will be a subset of chapters that appeals to you. If you're in business and making big financial decisions, it might be the corporate finance chapters. If you're an appraiser or a valuation practitioner, it might be the valuation chapters. If you're an investor, it might be the investing chapters. And across all the chapters, there are big picture issues that come up that hopefully will explain what we see around us in the economy and markets. I hope you enjoy the book as much as I enjoyed writing it. And I'd love to hear your feedback and what I think I can add to the book, take away from the book, and do differently. Thank you very much for listening.